It finally happened. On June 12th, 2026, SpaceX officially hit the public stock market, shattering records with an astronomical $1.77 trillion valuation. Across the globe, millions of retail investors like Maya stared at their phones, watching the stock skyrocket past $225 a share within minutes. The fear of missing out was electric. For years, everyday traders begged for a piece of Elon Musk's aerospace giant, especially after it absorbed XAI earlier this year to create an absolute artificial intelligence and aerospace titan. To the average observer, this felt like the ultimate wealth-building opportunity, the chance to finally get in early on the next generation of human civilization. Maya clicked buy, completely convinced she was capturing ground floor pricing. But here is the brutal truth that Wall Street never wants you to realize. By the time you can buy an IPO on your phone, you are not early at all. To understand how a public listing actually works, let us imagine a massive, highly anticipated new amusement park called Market World. Maya has been waiting in a massive, sweltering line outside the main gates for hours, clutching her wallet, desperately hoping to get on the Star Rocket ride. Meanwhile, Jordan represents the institutional mega investors, the hedge funds, investment banks, and elite insiders. Jordan does not wait in lines. Hours before the general public gates are even unlocked, Jordan and his wealthy peers are guided through a private side entrance with a glowing VIP pass. They do not just get early access, they buy up entire blocks of ride tickets in massive volume at a heavily discounted wholesale price. By the time the main turnstiles click open and Maya is allowed to sprint inside, the best seats are already occupied, and ticket prices are being aggressively driven up by extreme retail demand before she can buy. Now, you might point out that SpaceX's listing was praised for being deeply democratic, allocating an unprecedented 30% of its total shares directly to retail platforms like Fidelity and Robinhood. Maya felt special because she received a notification saying she was selected for this exclusive pre-IPO allotment. But let us look closer at the math behind this apparent generosity. When an institution gets shares, they receive millions of dollars in volume. When Maya checked her allocation, she discovered she was only allowed to buy a measly 3 shares because demand completely crushed the retail allotment limits. This tiny crumb is intentionally designed to generate massive public buzz and social media hype. The major institutions want millions of everyday investors excited, talking, and priming their accounts because they need a massive ocean of retail buyers to provide immediate market liquidity when the trading gates finally swing wide open on listing day next Tuesday. This brings us to the core issue of valuation versus pure hype. When SpaceX listed at $1.77 trillion, it did not just break records, it priced in decades of flawless, perfect execution. Jordan stands next to a chalkboard, showing that at this valuation, SpaceX is worth more than almost every legacy industrial and aerospace company combined. Maya wonders how a company can grow further when its baseline is already near $2 trillion. The answer lies in the earlier absorption of XAI, which injected pure artificial intelligence speculation into a heavy manufacturing company. Retail buyers are paying a massive premium for future Mars colonies and autonomous starships today, while the current revenue from Starlink and satellite launches barely covers a fraction of that enormous price tag. When you buy at the peak of the public launch hype, you are paying for tomorrow's dreams at tomorrow's absolute highest prices. This brings us to the hidden mechanism that triggered the sudden price pullback after the initial surge: the institutional lockup period. When a company goes public, early investors and insiders are legally barred from selling their shares immediately, usually for 180 days. Jordan knows this rule well. He understands that during this initial phase, the available supply of shares is artificially restricted, which helps drive the price straight up when retail FOMO peaks. But look what happens when that clock runs down. The massive institutions that bought in years ago at single-digit valuations are sitting on life-changing gains. As the lockup expires, they begin a systematic multi-month liquidity unwind, slowly trickling millions of shares into the open market to lock in profits. Maya wonders why the stock is steadily drifting downward despite good news. It is not bad performance, it is simply supply and demand rebalancing in the public markets. So, how does an everyday investor like Maya actually win in this institutional game? The secret is simple. Stop trying to cut the line on opening day. Instead of buying the chaotic initial spike, successful long-term investors wait for the market hype to cool off and the institutional selling to stabilize. Look at history. Almost every mega IPO experience follows a similar pattern, where the price eventually settles into a realistic valuation range after a few months. Maya decides to use dollar cost averaging, setting up a consistent monthly plan to build her position slowly over time, rather than throwing all her capital in at the absolute top. By shifting your mindset from chasing a fast lottery ticket to treating a company like a multi-decade infrastructure asset, you take the power back from Wall Street. You do not need to get in early to build life-changing wealth. You just need to stay in long enough. As always, appreciate you hanging out today. See you in the next one.